Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Hello and welcome to this live core conversation brought to you by Red Cloud Financial Services. I'm your host, Mark Bunting, the host of RCTV. These conversations are where we talk to leaders in the metals and mining sector. These discussions are informative, educational, and actionable. Our guest today will have some investment ideas for you later on in the show. Now, our guest is a strategic investor in the junior mining sector. He and his team provide fundamental bottom-up, long-short equity strategies to institutional investors and high net worth individuals as well. Let's bring him in here, Michael Gentile. He is the founding partner and what's his full title here? Senior PM, got it there. Bastion Asset Management. Great to see you, Michael. How are you?
Hey, Mark. Good to see you again.
Thanks very much for joining us. Now, we spoke a few months ago at a Red Cloud conference. You were one of our keynote presenters. And in our conversation, you talked about the 6 key criteria that you use and look at to assess junior exploration companies. And I think it's worth revisiting those 6 things, especially for those who may not have seen that interview. So can you briefly run through those 6 things that the key factors that you look at?
Yeah, so Mark, I've invested in the commodity sector for 25 years. Most of that, I'd say 18 or 19 of those years were investing in producers, small mid-cap producers, so 200 million to kind of 5 billion market cap companies. Over the last 6 years, I deployed a lot of my own personal capital in the junior exploration sector. And really, when I got involved there, Mark, the name of the game for me in junior resource investing is trying to find potential mines. I'm not interested in buying drill bit stories, assays, promotes, but really stories that have the potential to become mines one day. It's not an easy task when you're starting at a $5-10 million market cap with your first few drill holes in a deposit. So what I tried to do when I first started investing in junior resource sector extensively in my own capital was kind of reverse engineer, I guess, the hallmarks of what makes the existing producing mines successful, what made them not successful. And so I kind of walked through a quick criteria. It's not an exhaustive list, but it's the first thing I started with. Obviously, geology is very important. I'm not a geologist, so I rely heavily on my network of trusted geologists that I work with to de-risk projects for me, but obviously grade and scale is really important. So you got to have the grade to be commercial. Grade is margin. Grade's the profit margin you're going to have on your mine. And you got to have the scale. You got to have enough ounces or tons of whatever you're mining to justify the capital investment, the capex to produce that mine. So those are the first 2 things I look at very carefully. Secondly is infrastructure. If you have existing infrastructure in place, if you got mills, you got roads, you got power, you got airports, you got all those things in place that are advantage to the project, it's going to massively lower your capex and therefore lower the amount of grade and lower the amount of scale that you need to have a commercial operation. Third thing would be jurisdiction. That often gets misconstrued. People kind of say Canada, US bad, everywhere else, Canada, US, Australia good, everywhere else bad. I look at jurisdiction as what is a social license? What is the likelihood of being able to build a mine on reasonable timelines in these areas? And what is the stability of the mining code or taxation regime in those jurisdictions? So we can go around the world. Some parts of Canada and the US are fantastic to build mines. Other parts I prefer much less to West Africa. So it really depends on what jurisdiction, but really it's again, like I said, the timeline to production, permits, tax code, and ability to build social license in a community to actually build a mine on time and within a reasonable amount of years. Management is extremely important to me as well. That'd be my 4th criteria. What I look for in management, we could have a whole hour talk about that, but really the 2 things I look for is, does the management team have a right combination of financial markets understanding? So how to raise money, when to do M&A, how to raise capital, how to market, promote the story. And also equally important, strong geology and technical team. Some teams are geology heavy and very weak on financial markets and capital raising. Others are really strong capital raising, but extremely deficient on geology and technical skill set. So you got to have both those 2 things. And I overlay that with does the management team own a significant amount of the company? I want people with skin in the game. I want boards and management teams that own a lot of stock. Those are teams that are going to be up all night trying to fix problems, or up all night trying to create value for their shareholders. I don't like teams that don't own any stock in their company. And I don't like teams that have got all their stock for free. I like management that actually puts, cash checks in the company, putting their money where their mouth is, along to go with the sweat equity that they always deserve when they build these companies from the ground up. And then I overlay two things: cycle. So where are we in the cycle? Again, doing commodities for 25 years. My favorite setup, Mark, is a sector where you have a very positive macro outlook, or an improving macro outlook, where I foresee the commodity price in that sector to rise, or at the very least stay flat and stay buoyant for several years, but where the sentiment is very, very low. So sometimes that may be investing like I did in gold in 2015, when the sentiment was absolutely terrible. Gold was $1,100 an ounce, but I felt from a macro perspective, from a sentiment perspective, gold could only go up from there. And the sentiment was really very bearish. I had a positive view on gold while the sector was very negative. Or it could be like today, where the commodity backdrop for gold is excellent, $2,500 an ounce, but the sentiment remains terrible. So you've got a very positive macro environment, but the sentiment for the stocks is poor. I don't like investing when the macro is positive and the sentiment is wildly positive, where everybody owns the stocks, the valuations are full. That's how you can end up hurting yourself. And so that leads to my last point, which is valuation. When I get into a sector, or when I get into individual stocks, I'm looking to make 20 to 50 times my money. So I'm looking to make really large returns. So therefore, the valuation I pay on an entry point on a specific stock has to be appealing enough where I can see that kind of outsized return. And the reason is I make a lot of mistakes, because in junior resource investing, most companies do not become mines. So therefore, you've got to make a lot of money when you're right. And so that feeds into my negative sentiment. When sentiment is poor, overall in a sector, the valuations are extremely low and you get more bargains. And then you can kind of go on a shotgun approach and try to find the best deals in an already heavily discounted sector or market cycle. That's where you can make outsized returns if you're patient and you have the stomach to invest when things are poor.
Further to those points, so Michael, from a major producer perspective, you said that the three things they really look at are scale, good grades, and infrastructure. And do you think that maybe too many companies overlook that, or investors overlook that when they're assessing a junior player?
Absolutely, Mark. I think when I get involved in talking to a company that's drilling their first few drill holes in the project, I always ask the question, like, what do you think if you're right? What kind of size and grade and scale do you have? Obviously, it's hard to answer, and geology is unpredictable in certain ways. But yeah, if you're sitting in an area where you got no infrastructure, you're sitting in North Yukon, or sitting in northern Quebec, or northern Ontario, you need to build all the infrastructure yourself. So if you've got to put the roads, the power, all that stuff in, you need to have deposits that have 5, 10, 15 million ounces or more, if it's a bulk tonnage deposit, to justify the investment. If you make a discovery, 5 kilometers away from a 20,000 ton per day mill, well, then even 500,000 ounces, if it's a good enough grade, can be immediately ore grade feed for a mill and make cash flow immediately for the larger producer. So yeah, infrastructure and understanding really what's the hurdle rate, what is the size and the economics of a deposit required to pay for the infrastructure. If it's already there, obviously that hurdle is much lower, and that means your company that owns those ounces are probably likely to be worth more and more attractive to other companies in an area that are already active than doing it from scratch. That being said, if the geology is so compelling and the size of the prize is so large, I don't mind investing in areas where there's no infrastructure, but I'm going in eyes wide open saying, I've got to be looking for a very large, very exciting type discovery to allow this to become a mine one day. And so therefore, if it's subscale or not as big as I thought, then it's probably a stock I want to exit. If it ends up being that kind of scale discovery, well, then that'll attract attention. Look at something like Snowline. There's no infrastructure there, but that stock has done very well because they've got 10 to 15 million ounce endowment in that property, and therefore the infrastructure will be justified for that project over time.
Michael, two other things worth revisiting from our previous conversation are the Lassonde-Gentile curve, your variation on the famous Lan Curve, named after Pierre Lassonde, of course, the 5 stages from discovery to production. So let's start there. Well, what is the Lassonde-Gentile curve? How does it vary? How is it different?
Yeah, in all humility, I haven't paid Pierre Lassonde any royalties to attach my name to his, nor do I deem myself worthy of the same conversation, his fantastic career that he's had. But I did tweak that curve because I want to explain to the viewers we had, or the people we had live last time in Toronto, how I look at investing. So the Lassonde curve is very well known. You have a pre-discovery stage company, you make a discovery, you have a big run up in the stock price. As long as the discovery keeps growing in size and the tonnage or the ounces continue to grow in size, the stock continues to do well. And then they enter a bit of a fallow period that could be kind of 2 to 5 years, where they move into project studies, preliminary economic assessments, feasibility studies, where you're in that building or economic study phase where it costs money and the sizzle sort of comes off the steak, so to speak, a little bit. And then once you get into production, you have another big run up. So I fully agree with that. If you look at the history of mining stocks, that's typically how they trade. And I'm very aware of that when I'm investing in these names. But I overlaid what I said earlier about my macro views, because the Lan Curve can shift up or down in terms of valuation, right, on the x-axis quite easily, on the y-axis, sorry, quite easily, because sentiment will change. So if you go back to the lithium sector 3 years ago, an early stage exploration story in the lithium sector when it was red hot and the hottest thing in the market would have a $50 million market cap. Pre-discovery, just an appealing land package next to other known lithium discoveries that have a $50 million market cap. That same setup in the gold sector, exciting land package next to known discoveries, might have a $5 million market cap. So the lithium market cap would be 10 times larger for, in theory, the same risk reward opportunity. So if we go back again to what I said earlier, if I'm looking to make 20 to 50 times my money, and my starting ticket is a $5 million market cap versus a $50 million market cap. Well, if I want to make 10 times my money, that $5 million has to go to 50 million, or it's got to go to 100 million to make 20 times my money. Well, that $50 million market cap has to go to 500 to $1 billion for me to make 10 to 20 times my money. So when things are depressed, every valuation across the whole Lan Curve in an industry will go down. So therefore, you're buying things at a lower entry price, and therefore your overall return when you make a discovery or when you get into production will be much higher because you're paying a much lower valuation. I think a lot of investors don't look at that. They get caught up in what's hot, the frenzy that's going on, but they're not cognizant of, okay, if I'm right, I'm going to make what? If I'm wrong, what am I going to lose? And obviously your downside's a lot lower if you're buying things at a much lower valuation, with the caveat that you've got a positive bias that the commodity is going to improve and that Lan Curve will shift up. So that's why it's a combination of depressed sentiment from the part of investors with my own macro view of things are going to get better in the sector, causing the Lan Curve to shift up. So that's the kind of the tweak I've added to the Lan Curve on my investment approach.
All right, very interesting. And another formula in searching for these 20 to 50 baggers. And as you've said, and others have said, that really only 1 in 100 projects have become a mine. So what is that formula to increase your probability of getting big winners and offsetting some of the losers?
Yeah, so I think if you just threw darts at a dartboard, Mark, if you take 100 juniors on the TSXV and just threw 100 darts, it might even be less than 1 in 100. So what I try to do with my approach that I walked you through earlier, those criteria that I look for, if they fail one of those criteria, it doesn't mean it's not going to be a mine, doesn't mean I haven't made a mistake, but that would probably eliminate 8 out of the 10 investments that I look at. So you're increasing your odds because you're eliminating investments early on, even before they drill or spend a lot of effort, a lot of money to move a project forward, that projects that have the cards stacked against them, that are lower probability than 1 in 100. If you're taking all the stuff off the board, it's going to be 1 in 1,000 or 1 in 2,000 likelihood of success. You're then concentrating your bets in a higher percentage likelihood of success. So that's what I try to do with my filters, with my experience, with my 25 years looking at commodity stocks. By saying no to the lower probability outcomes or the lower probability events that these companies could become mines because there's a red flag or a showstopper along the way, that should improve my class batting average above the 1 in 100 or 1 in 200, whatever it is, that become mines globally. And therefore, if you're getting more shots on goal of higher quality projects that have a chance to become mines, those future mines are the ones that do go up 20 to 50 times. So it's all about probabilities, batting average, what you want to call it. I take a venture capital approach where I spread my bets over 25 different companies or more, and hoping for 3, 4, 5, or 6 of them really to have exponential returns, knowing full well that many of them will fail. But those winners are going to pay for the rent and result in a really impressive return stream over time if I time the cycle right and time investments right.
Let's have you put on your macro cap here for a second and talk commodities in general. They had a pretty good first quarter in 24, especially the likes of copper and uranium. Things have cooled since then, in part because China has weakened as well. So what would you say is your macro view right now, generally, on commodities? Yeah,
so I would say in general, I've had a preponderance of my investments in the gold sector, both institutionally and personally, for the last kind of 18 months. I'm not ruling out investments in base metals. I have made investments in base metals because, again, it's a project by project basis and a risk reward assessment that I make. But in general, my view and the view of my investment firm has been that the economy will be or is cooling. It's cooling now in real time. We saw the jobs numbers today were really weak again in the US. So We think the economy is slowing down. Hard landing, soft landing, we can debate that later, but there's clearly a slowdown in economic growth in the US. Clearly things in China have been weak or soft for many months now, a couple of years now. So that typically would tell you the economically sensitive commodities like oil or copper would have a little harder time, and they have. We could talk about the dynamic of supply demand, which is positive, but in general, in a slowing economic environment, the more economically sensitive metals will struggle. And so I've been putting more money into gold and precious metals that are decorrelated from economic growth. Actually, the worse the economy gets, the more chance you have rate cuts, the likely that gold will do better, and those stocks should do quite well. So that's been my house view. That being said, I think copper has some really nice supply-demand dynamics longer term. I think we're definitely short copper for the energy transition that we're going through globally. The deposits are lower grade than they were. They're harder to find. They're smaller. They're less profitable. They're more expensive to build than ever. So longer term, I am quite bullish on copper pricing and copper demand. And that's why you've seen, despite economic softness, copper is still hanging above $4. In previous cycles, you'd be down to $2.50 or $2 in a soft economic environment. It's at $4 today. So I remain quite constructive on copper longer term. Oil, I think supply-wise, we're in good shape. I mean, OPEC's got some excess supply still in the pipes, but the U.S. onshore surge that we've seen, I think, has come to a head. We're not going to see the same type of supply growth we see in the U.S. and Canada. Most energy companies are living within cash flow and trying to stay flat production, pay dividends, and buy back stock. So supply side is good on oil. I think the supply is going to be more restrained in the future than people think. But again, demand is soft right now due to global soft economic growth. So we've been relatively cautious on the oil side as well, but constructive in the long term. So copper and oil, looking for long term, looking for episodic involvements in high quality companies trading at good valuations. Precious metals are more aggressively allocated these days because the valuations are still very attractive and the macro setup is very bullish.
Right. In a recent interview, Michael, I saw you say, and I'm paraphrasing, you've never seen a setup like this for gold stocks. You've never seen a situation like this. Is that because there's still such a disconnect, even though gold stocks have done better, still such a disconnect with gold? Can you explain that comment?
Yeah, if you go back to my Lan Curve, Gentile Lan Curve analogy, typically when any commodity, now it's gold, is making new all-time highs. Gold made new all-time highs this past week or the week before, $2,500 an ounce. Typically when any commodity is making new all-time highs, it's all over the newspapers. The Uber drivers, the cab drivers, some people in the subway are talking about what gold stocks they own or what commodity stocks they own in that subsector time. You would never know by looking at the average investor's portfolio or talking to the average investor that gold's making new all-time highs. The apathy level mark in the sector remains extremely high. In the junior resource sector, it's despondent in general in terms of the interest and share prices to companies. So typically when you're getting these bargains on the Lan Curve valuation, where you're getting things at really low valuations historically, depending on what stage of the Lan Curve you're on, you're typically in a stage where you were like in 2015 when gold's $1,100 and it's super negative and people are really bearish and the commodity's making new lows. You rarely see this type of valuation setup and this type of apathy when a commodity is making a new all-time high. So that's why I said I've never seen it in my 25 years. It takes a lot of the risk out of investing in these stocks because the larger corporates have clean balance sheets, generating huge amounts of free cash flow, will need to grow at some point because they're a depleting business. Every year you produce gold, you have less gold in reserves from the year before. So it really takes a lot of the risk out of this proposition because typically when you're buying negative sentiment, you're hoping that the sector will turn. You're hoping that the commodity will increase in value. Whereas here, the macro is fantastic. The commodity price is fantastic, yet the stocks are still trading at very depressed valuations. So for me, that is an incredible setup, a really good risk reward proposition. And I think what has to happen, you haven't asked the question, Mark, but what's going to change? I think the stock market rolling over. I think the average earnings of the average company, S&P 500, is going to be challenged going forward because the consumer is rolling over, the economy is rolling over. If the tech stocks start to roll over, a lot of that money will flow out of the more generalist investing themes and into gold. And as you know, the gold sector is a very small market cap sector. So even a small percentage of allocation out of the other sectors into gold will result in a really large move in these stocks. And they should be the only industry showing increasing earnings, revenue growth, beating consensus estimates, and having positive fundamental revisions higher, where the rest of the market, I think it will be in a kind of topping phase of economic estimates and earnings estimates being to the downside. So that's what I'm quite excited about for the back half of this year into next year.
Right. And we're both old enough, and anybody old enough to remember previous gold bull runs. When they move, it can be really explosive. Let's dig into your portfolio now. You've said that you generally have more than 20 investments in exploration companies, and you break that down into producers, advanced developers, and explorers as well. First off, Michael, have there been any significant additions or subtractions lately in the portfolio that we should know about?
Yeah, so my model, Mark, I'll explain to you how I do things. I have that venture capital approach to investing. So I'll typically start off with a 1% position in my portfolio, 0.5 to 1% position in a more early stage investment. Might have a market cap of 5 to 15, 20 million market cap. And I spread those bets, over a large number of companies. As they have success, make a discovery, go into resource definition, maybe into the mine building or potential development story, I will press my bets or increase my investment in those companies because I see they've crossed the bridge, they're ticking more and more boxes. The likelihood of it becoming a mine is increasing. And that's how they move from 1% to maybe 5 to 10% of my overall portfolio, both through hopefully appreciation of the stock price and then additional subsequent investments, typically on financings where I'll be increasing my position in the company. What I also do, I don't have any inflows. So my personal capital is invested in the junior resource sector. Institutional capital is invested in the more producers and the more mainstream de-risk stories for our institutional clients. So since I don't have any inflows in the junior resource sector, the liquidity events when I have takeouts, companies I've had 5 or 6 takeouts in the last 5-6 years. When companies get acquired and there's a big win in my portfolio, I will then take that capital and recycle it into a bunch of new names, a bunch of new 0.5 to 1% positions in that earlier stage basket. So lately, Mark, I haven't had a takeout for a while because the market's been quite depressed. So what I've been doing recently is basically the cash flow I do have and the money I do have has been really supporting the winners, the ones identified as winners in the portfolio. So I've been increasing my investments in the ones that I think have real shots to become mines and have real shots to be acquired in the next 12 to 36 months. So you made additional investments in Radisson Mining in the past, and North Isle Copper and Gold, and Northern Superior, and Group 11 quite recently, Roscan Gold. These are all stories that I think are on the cusp of the next premier development stories globally, and the ones that could have a shot to be acquired in this upcoming cycle, while sprinkling a few bets in the smaller stage, earlier stage, smaller companies across the board, eager to redeploy some of those proceeds on liquidity events. I don't trade my stocks, Mark. I buy 10% of a company and then I'll hold that for 3 to 7 years. My liquidity event is typically when management exits or sells on a takeout. So I don't trade around stocks. So I'm a very sticky long-term holder. And so my portfolio dynamics is often affected by what's going on in the portfolio and what liquidity events or what corporate actions are happening in the portfolio that year or that month.
In terms of more particular specific names, let's start at the top of the food chain, so to speak, with producers such as K92 and Cali Mining. They've been big winners for you in the last 5 years. Stocks up anywhere between 250 and 280%. How long have you held those? But also I'm curious to your point about you don't trade around them. You want to keep your position for 3 to 7 years. But Cali had a big run, pretty well unwound all those gains into 22, and then another big run. So did you do anything with that stock specifically, or you just wrote it out?
Yeah, so Cali, we own that at Bastion Asset Management, our institutional platform here. And yeah, that's a story we really liked. They were in Nicaragua. We owned a decent sized position. I think the stock was trading on $1 or $1.10. I forget where the stock was. And they had a little flare up in Nicaragua, a little political headline risk where there was some turmoil in the country, and the stock got demolished. It went from $1.10 to maybe 60 cents in a span of 2 to 3 weeks. So that's definitely something where, again, as you mentioned earlier, as you can tell, I'm very valuation sensitive. I'm looking at the potential return opportunity when I get involved in something. So we definitely at Bastion took that opportunity to dramatically increase our position at Cali at 60 cents because we felt that political flare up was a passing frenzy and not something systematic for the country. So definitely we take advantage of those down dips. When the valuation gets lower and we love a company, we want to buy more of it. We're not afraid to step in and do that. That goes from my own personal capital on Bastion. So absolutely, we took advantage of that. And also the same way, Mark, when they made the acquisition of Marathon Gold, the Valentine assets that Marathon Gold held, we really liked that acquisition. And the stock took a little bit of beating when they did that acquisition because there's a lot of merger arbitrage and a lot of selling on the back of that deal. And we dramatically increased our positions there again. So if you like a story and the stock is getting dislocated or beat up for a reason that we feel is transitory, or maybe even it's getting beat up and we actually like why the stock is down because the news is actually good in our view, we're not shy at all to dramatically increase our investment.
All right. What about Arizona Metals? Because you've called this the most exciting copper gold project you've ever seen in your career. This one from 2019 into March of 22 was up by more than 3,500%. So huge winner for you. It's still up 900%. So it's unwound some of those gains. What have you done with that? Have you been adding at lower levels?
Yeah, so Arizona Metals, I'm really excited about what's happening at Arizona Metals right now. They just brought on a new management team. Duncan Millamis, who was at Wesdome Gold Mines prior, and Jacques Perron was a long and successful history on multiple mining companies. These are two gentlemen, Mark, that ran multi-billion-dollar market cap companies. Both of them had multiple takeouts in their career. It's very unusual that you see two executives of this tenure and quality go down cap. So Arizona Metals today has around a $200 million or so Canadian market cap. And you had guys that are running multiple billion-dollar companies come in as CEO and chairman. And I think the reason I spoke to Duncan a bunch of times already since he's joined the company, but the reason is they see what I see. They see a very high quality, extremely high grade, very mineable deposit in an excellent jurisdiction of Arizona. The stock had a huge run, has pulled back quite a bit, as you mentioned. I did buy some more stock when Duncan came in as CEO. I own a huge position. It's the largest position in my portfolio today. And Duncan's been pretty quiet the last 2-3 months. He's about to go to Beaver Creek next week, where he's going to lay out his 3-year plan. Part of the problem with the stock recently, Mark, has been there wasn't a really coherent multi-year plan from management to de-risk the asset in terms of doing the preliminary economic studies, the metallurgy, feasibility study. This is a premier development asset, and the resource, I think, will be very, very good, very high grade, very, very profitable. But you've got to put the steps in place to de-risk that, put the economic studies out, and have a credible, mine building team. So the old manager did a great job identifying the asset, making this fantastic discovery. Now you've got proven mine builders in here that know how to de-risk the asset. And the stock today, by my calculation, Mark's trading around 0.1 to 0.2 times NAV. Their peer group in the copper gold space of high quality development asset might trade at 0.5 to 0.8. So a lot of room to run in this stock. You've got the team in place, you've got the asset in place, and the valuation is very attractive. So I'm quite keen on it. Despite it being my largest position, I bought some more stock, and I remain very positive on it. I think we're going to have another big run here in the stock in the months ahead.
Okay, nice update on Arizona Metals there. Looking at explorers, we know that you own North Isle, Copper and Gold, and Northern Superior. And we also know, because we saw you at a chopper, that you visited the North Isle's project recently in BC. Can you give us a few words on that one and then Northern Superior?
Yeah, so it's back to our earlier discussion about infrastructure. I mean, North Isle, Mark, is a perfect example of an infrastructure advantage project that I really do like. So this project's in North Vancouver Island at the very far north end, very industrial, very mining friendly. Port Hardy. We actually met the mayor of the town when we went there. She's used to work in a mine, worked in the pulp and paper business as well. So the mayor of the town, the representatives, the locals are extremely in favor of mining. And why they're in favor of mining is in the 70s, they had the Island Copper Mine that produced a large amount of copper, multiple billion tons of copper. So they've got existing port infrastructure in place. They've got 35 kilometers of logging roads in place. They've got paved highways. They've got power coming directly to the site. They have a new wind farm that was just built on the site. So all those things are extremely expensive, as you know, Mark, to build. The project is a 10-minute drive from the airport. They used to land Boeing 747s there, 737s, because they had so many workers coming in. So they got a really large airport, much larger than they need today, but that's also extremely advantageous for a project. So a 10-minute drive from the airport, fully paved roads to access the whole site. I went by helicopter because you could see the whole 35 kilometers in an hour, but you could literally drive the whole thing on roads, which is a huge advantage. And they've got already a very attractive preliminary economic assessment of a project that came out, I think it was 2019 or 2020 when they put it out. But the game changer to me, Mark, that led me to increase my investment, go to about 9.9% owner of the company, was they made two high-grade discoveries called Northwest Expo and recently West Goodspeed that have 2 to 4 times the grade of the existing deposits. They already had a good project that could make really good money in a $4 plus copper world with good scale. But then they found really high-grade gold and now seemingly even higher-grade copper right next door to their large bulk tonnage project. So that's your high-grade, low capex, quick IRR, quick payback return, high IRR project that could fund the larger development, which is extremely important in this mining market, Mark. So that's a big game changer. And I love the long-term exploration upside. They're scratching the surface of this world-class belt here, and the exploration team is doing a fantastic job. So, I don't go to site that often, Mark, because I don't feel like I add a lot of value. If I go to site, I'll go with a geologist or a mine engineer that can really ask the right questions and teach me things. But I do go to site for the projects that I think have real shots to become mines, and in the robust copper gold market that we forecast are in already, this project's dramatically undervalued and will be, I think, a prime takeover target in the coming years as copper companies look to grow their portfolios and increase production.
All right. On the other side of the ledger is a name like Serado Gold. We've interviewed the CEO, Mark Brennan, a few times. The company seemed to be swimming along, producing in South America, growing reserves, growing production. And then they ran into some difficulty. They delayed their financials to the market, and then got a cease trade order from TSX Venture. So what happened there? Is that a broken story? Can it recover? What have you done with your position?
Yeah, so I like Serado for a couple of reasons. And obviously, as I mentioned, the mistakes happen in this business and things you can't control happen in this business. So why I like Serado was they had a cash flowing asset in Argentina producing around 50 to 60,000 ounces a year, which was generating some good free cash flow. And then they had this development asset in Brazil that was going to produce, I think, 100 to 150,000 ounces a year, modest capex of 200 million of capex. So unlike most juniors, Mark, who are development stories, they had the cash flow coming from Argentina that I felt to a large degree could fund a significant portion of the capital expenses to bring Brazil online and basically get to 150 to 200,000 ounces a year of combined production without issuing a whole lot more equity, which would be very powerful for the stock price. Unfortunately for them, Mark, they had a major production hiccup in Argentina, a couple of quarters of really weak production where that free cash flow turned into negative cash flow at the same time where they were hitting some increased capital calls or expenditures in Brazil as they were ramping up that asset. So that caused the company to fall into a bit of financial difficulty. Unfortunately for them, due to the cash crunch that they had, they were forced to sell the Brazilian asset to Hochschild Mining. So it was or optioned it out, which is they have an option to sell the rest of the asset in order to pay the near-term bills and the negative cash that they were throwing off in Argentina. So that took a little bit of a bloom off the rose for me, Mark, because I really liked the Brazil asset. And that was the source of my 10 to 20x return that I was hoping to make in Serado. They've subsequently righted the ship. Their production's back on track in Argentina. The cash they got from the asset sale has stabilized the balance sheet. So it's now a 50 to 60,000 ounce a year producer in Argentina and a very high gold price. So it's not an unattractive story. But for me, what I was looking for was the big kick from the Brazil asset. And now that that's sold, it's dampened my enthusiasm somewhat for the story and I've obviously lowered my position in that investment.
All right. Lastly here, Michael, let's get some final words from you. You've called yourself a contrarian investor, a counter-cyclical investor. You say you learned a lot of lessons as a younger man. So as you look at the markets right now, are there any trends or certain commodities or types of companies that are intriguing you that are maybe out of favor?
Well, look, I'm obviously biased because I have the majority of my net worth invested in commodities right now. I would say, I've learned the hard way, Mark, over the years that you got to be brave and you got to buy when there's blood in the streets. You got to buy when things are really negative. Again, that's where you're going to get the best value. If you're looking to make the most money in the next 30 days, go and buy an AI-based or tech-based stock, and you have a much better chance of making money in the next 30 days. If you want to make outsized returns, true, outside the norm, above average returns over multiple years, you've got to dip your toe in the water in things when things are negative, when the valuations are compressed, when everybody hates it, when you have a view that nobody else does. The famous movie and Michael Burry with his headphones on listening to heavy metal music when he was short mortgages in the US, right? That was a very contrarian move that he had. And the consensus move was buy mortgages, buy real estate, you can get rich forever in the US. He was standing against the crowd who were yelling at him saying this is the best thing ever. He was short and he was losing money. Like I've lost money the last 6 to 12 months or more in junior mining stocks because my view is directly opposed to the consensus. My view is that commodities are trading at record low valuations versus the Dow Jones versus the S&P. Hard assets are going to do extremely well in a devaluing currency environment. Right now we're being validated by the commodity prices, but the stock prices are not moving. So that contrarian attitude is allowing me to pick up companies at what I feel is 5 cents on the dollar. If you want to go buy something at 110 cents on the dollar and hope to sell it at 120 cents on the dollar, That's a very hard game because you're basically trading a hot potato, hoping someone else will buy from you at a higher price when it's already trading above its fair value. I'd much rather be a contrarian, buy things at 5 cents on the dollar. Maybe they go to 4 cents on the dollar, but the move from 5 cents to 100 cents on the dollar is 20 times your money. And that's how I invested over the last several years. That's how I've made significant returns, outside returns for myself and my investors. But you got to have patience, you got to have thick skin, and you got to have a strong stomach, because things can always go lower than you think. But when they turn, you have very explosive returns going forward.
Here's my last question, actually, Michael. I realize I skipped over this one, and it's a macro question. You've talked before about an estimated 300 trillion plus in debt globally. The U.S. makes up, let's say, roughly 10% of that. The two presidential candidates seem willing to keep on spending. And you've also said that you see a crisis coming of some sort at some point. So do you have any sense of how that might manifest itself and what that would mean and how that would impact gold?
Yeah, I mean, the numbers I've been talking about this, Mark, for 6 years, almost nonstop. And I'm a simple guy. Simple math usually works best and for the eyes of most investors. At one point in time, when I first got heavily into commodities, we have $20 trillion of debt. And I said, 5% on 20 trillion would be $1 trillion a year of interest expense. And the US top line was $4 trillion. At the time rates were zero, so no one cared about that. Fast forward to today, the $20 trillion has gone to $35 trillion. Interest rates are at 5%. And so when all that debt rolls over in the US at 5% interest rate, you're talking about 1.7 to 1.8 trillion dollars a year of interest expense only. And the entire top line of the government would be 5 or 6 trillion. I don't know what the exact number is today. So a third, 33% of your overall spending, a revenue in a given year, will go to interest expense. If you and I had that true in our personal financial statements, Mark, we'd be insolvent. So the US government, by any stretch, cannot afford 5% interest rate on their debts. And that's why the calls are increasing for rate cuts. And they're doing this in a time where the economy has been relatively strong. We don't have a recession yet. So when you have a recession, the revenue line for the government decreases dramatically, but the interest expense will not. So the only way out of this, Mark, is money printing, a monetization of the debt, whatever you want to call it, printing more dollars that you don't have to fund your interest expense. That is incredibly positive for hard assets like gold, copper, oil, all those things that are fixed in terms of supply should increase dramatically in value. Just today, Mark, I saw central bank gold buying in July was the strongest month of the year in 2024 in terms of tons. And that was after a 30% move higher in the gold price. So what you're laying on top of that is, I think central banks, foreign governments, other holders of US dollars, US dollars are around 60 to 70% of global foreign currency reserves. They can do the same math as me and say they're going to get paid back in dollars that are worth less and less and less due to money printing. And so they're slowly rotating their currency reserves out of out of US dollars into gold. And you're seeing consistent central bank buying for the last 2 years. I think that's going to continue for multiple years because gold is still only about 15% of foreign currency reserves, while US dollars at 60 to 70% range. So every year, 1 or 2% of that rotation out of the US dollar into gold is an extremely powerful tailwind. So money printing is going to happen. There's no way we can fund the debt with the levels we have today, with the revenues that we have today. And therefore, I think that rotation to gold is going to be a multi-year trend. You already see it in the gold price. You're not seeing it in the stocks yet, but that is the next chapter for this market. And as more and more investors realize that, that's going to cause buying of the equities along with the physical gold that we're seeing in the market today.
Michael, this was excellent. We covered a lot of ground. You did, more specifically. Thank you so much for joining us today, and we'll see you again.
It's always fun, Mark. Enjoy your questions.
All right. Excellent. Michael Gentile, founding partner and senior PM at Bastion Asset Management. How great was that? You got all those investment ideas. You can't go wrong talking to Michael Gentile. Thanks for joining us today. We're going to keep doing these live core conversations. We have more lined up in the fall. So keep tuning in and check out Red Cloud social and their websites as well to keep track of what we're up to. The Red Cloud Research Portal is complimentary for investors, all sorts of great advice there, or at least analyst reports. And you can rewatch the replay of this on YouTube. Thanks again for joining us. We'll see you next time.